Well, hello everyone. Welcome to my studio here in fabulous Las Vegas. My name is Dean Tenney. We on the YouTube channel have gone through quite a few exams. So we have a playlist for pretty much all the series. If the series that are missing or sometimes will show up, but in those series playlist, this is series 65 playlist. We try and provide a couple narrative lectures, an explication of the content outline. That's what we've been working on, and we'll continue to work on that this evening, as well as a practice exam. So I would just remind you, 65 test takers, that in this playlist, there's already two narrative lectures. I highly recommend it, no surprise. One is on the Uniform Securities Act, target rich, definitely check it out, as well as one on investment advisors. There's also 50 analytical practice questions and a practice exam, and we're going to continue to move on with the explication of this test specifications. I would use these as an inventory, intellectual inventory. So as you print this out, follow along. I'm not going to be lecturing. I got a 2-hour lecture on mutual fund in the playlist. I highly recommend. No surprise again, those narrative lectures. But what we're going to use this for is just to tell you what the test implications are. A lot of times people ask me, well, gee, how do you know that's not on the test? Because, if it's not in the test specifications, they're not allowed to ask it. So that's how I know. All right, so let's get started on the explication here. You're definitely going to get a 3 questions here on types of pooled investments. And one of those is surely going to be the distinction between an open-end fund. Let me get my cursor going here, and a closed-end fund. In an open-end fund, they're continually offering new shares to the public. Continually, yeah, I'm not going to worry about spelling. Offering new shares to the public. And that has some implications. That means that these are primary transactions. Remember in your exam, what that means is the issuer is receiving the proceeds. And so you're doing business directly with that mutual fund company. And that would be the same. It kind of aggravates me on, when I see vendors refer to open-end funds as when you sell them. You don't sell them, you redeem them. So whether you're coming or going, you're doing business directly with them. And you're redeeming those fund shares at the next calculation. Calculation of the NAV with redeem shares of the next calculation of the NAV. So once they get the mutual fund sponsor, distributor, underwriter gets your request, they're going to do the next calculation. They're going to give you your money. So that's kind of cool. You have guaranteed marketability at the next calculation of the NAV. They have to meet that within that redemption request within 7 calendar days. Now, what you have to be able to do on the exam is contrast that with a closed-end fund. A closed-end fund does a one-time IPO, and then it trades in the secondary market as a secondary market, meaning these are secondary. Let's just kind of keep it consistent here, secondary transactions. And therefore, these are secondary transactions taking place in the secondary market. Now, what that means is you don't have guaranteed marketability at the NAV. They don't meet redemption requests. And that might be the reason I have chosen to use a closed-end fund in your portfolio as an investment advisor rep, because I don't need to worry about the manager having to meet redemption requests. So these trade supply and demand, and they might be trading at either a premium or discount to the NAV. I had somebody who missed the day of class 65 class when we went over mutual funds. So don't make this mistake. She knew mutual funds. She thought well enough, and she passed good news. She called me, said, Dean, there's stuff on mutual funds. You didn't tell me that. I said, well, you missed the day we talked about it. Good news, she passed. Now, the other distinction I might make you do, right, is that if we're talking about an open-end fund, the maximum sales charge there is going to be 8.5%. So if I do an NAV public offering price calculation, it comes up more than 8.5, it's going to be a closed-end fund. All right, so definitely going to get a question about that. And as I said, the major distinction is this idea between primary transactions and secondary transactions. Now, there are certain types of pooled investments. Pooled mean, what we own is proportion ownership of a pool of investments. In this case, a mutual fund's a portfolio, right? And then we, as the mutual fund shareholders, own proportional ownership in that. And, one of the problems with pooled investments like a mutual fund is they are subject to the Investment Company Act of 1940. And, there's a lot of rules, and we may not want to follow those rules. And so there are types of pooled investments that are not subject. Looks like it's not putting that red. Let me change. What I'm doing when I'm doing red, if you've been following around the explication, so I'm trying to distinguish what are Dean's comments from those of what come from NASA. Okay, we'll give this one more try. And if it doesn't work, I'll just leave it in black. There we go. And that's not true of private funds. Private funds, whether it's a hedge fund, the one thing a hedge fund doesn't do is hedge. Private equity fund or venture capital funds, those funds are all sold under an exempt transaction that you should be aware of. We don't use this just for private funds. We use it for all types of investments. But remember, this is called a Reg D. And a Reg D private placement is how these are sold. These are organized as partnerships, and they are sold under Reg D as a private placement. And remember, that's very important to know that is an exempt transaction under 33 and does not need to be registered under the Uniform Securities Act. Now, whether you want to call it federally covered or not registered, the point is I'm not going to have to qualify it. I'm not going to have to coordinate in a private placement. So these are all sold that way. And that's important because that means they're sold only to accredited investors. So if you're not an accredited investor, then, no hedge fund, no private equity fund, no venture capital fund for you. There are 3 questions in these types of pooled investments that we're discussing. And hedge funds do all kinds of crazy things that mutual funds can't. They can use options. They can sell short. They can use futures and commodities. And so sometimes we lose some of our mutual fund managers and they say, hey, listen, if you like me under the Investment Company Act of 1940, you're going to love me with no rules, right? The first guy who set this up, set one of these up is, made the compensation model that of 2 and 20. So most of these have a compensation model of 2% of assets under management and then 20% of the profits. Wow. That's something that as investment advisor representative, we should know the compensation to the hedge fund manager. Now, the fund itself, the private equity fund, whether it's, Carlyle Fund 6 or Blackstone Fund 7 or TPG, Credit Enhancement Fund 8, the funds aren't registered with under the Uniform Securities Act or the 33, but the fund managers are typically the managers of these private funds are typically registered no hedge fund, the managers are the general partner, and so that they're organized as a partnership, and that general partner will be a federally covered investment advisor. So managers of these private funds are typically registered as federally covered investment advisors. The funds aren't registered, but typically the managers are. And remember what federally covered means, very testable. That means they have $100 million of assets under management. Managers of the private typically registered as federally covered investment advisors. Venture capital, just, again, for your own edification, I don't think it's, high risk on the test. But private equity funds typically take public companies private, fix them up and then sell them to either a strategic buyer, or they sell them, take them public again when they can get a higher valuation. So private equity typically is buying ongoing business enterprises, and venture capital are typically making early stage investments in companies. So hedge funds are active in the secondary markets. Private equity, venture capital are primarily involved in, again, the primary market. UITs, I have had people tell me they've seen a question about UIT. And in a UIT, unit investment trust, the assets are professionally selected. So the assets are professionally selected. But then they're passively managed. And what we mean by that is Nuveen is big in this category. So they'll professionally select some great municipal bonds for tax-free income. And then I will decide whether I want to put this portfolio, this fixed portfolio, let's put it in there, into your account as your investment advisor representative. And I look at the bonds. I say, well, these are some beautiful looking muni bonds. And then that tax-free interest will get paid, pass through to the unit investment trust holder. And as the bonds mature, that would come out to you as well. We could do this with any kind of an investment, but they're typically, well, I shouldn't say typically, the big ones are unit investment trusts, where we go out and buy, for example, municipal bonds or, some other portfolio, and professionally selected, passive managed. And that portfolio is fixed, meaning if you don't like that, well, then you shouldn't get involved. ETFs, very testable. There are things that people don't like about mutual funds. A lot of people don't like this idea of forward pricing. When you get into the fund and you get out of the fund, in fact, let's put that up there. Very testable, forward pricing. That means that, I can't tell you how many shares you're going to get. I said, I don't know how many shares you're going to get, because, I'm going to send your check, off to the underwriter or sponsor. They're going to cash in. It's based on the next calculation. And when you redeem, I don't know how many shares you're going to get. Another thing that is Investment Company Act of 1940, open-end funds we don't like, is they can't be purchased on margin. Reg T says we can't lend you money to buy new issues. Broker dealers can't lend money to buy new issues. And under Reg T is part of the Reserve Board. It's considered a new issue 30 days from the effective date. I'm kind of hinting that after you've had the mutual fund fully paid for, let me go back here. For 30 days from the effective date. That's a low probability. I'm just setting up this idea of how ETFs, and that's the test question, how ETFs are different than our mutual funds. So in an exchange traded fund, you're typically going to be able to buy this and sell it in the secondary market. So these are more of a trading vehicle as compared to a open-end mutual fund. So more of a trading vehicle as an investment advisor rep than a long-term investment vehicle in your portfolio. So I'm using this more as a trading vehicle. And these two and ETFs trade in the secondary market, supply and demand. Now, you got to know, how are these different from other pooled investment? The other pooled investment they want you to be able to contrast with is the open-end fund. So ETFs trade in the secondary market like a closed-end fund. They're not closed-end because closed-end has active management, and ETFs are typically not trading. And so that means they're going to have a lower cost structure. And let's do that first. Because of this idea, I always joke there is a problem with having monkeys harvest bananas, and this would be the problem, right? So more of a trading vehicle, and ETFs trade in the second, they have a lower cost structure. They can be purchased on margin. As we said, open-end funds cannot. And you can sell them short. Can't be sold short. One of the disadvantages of a mutual fund is you give up tax control of your investments. If I have a security in my portfolio, I decide when to sell it. The capital gains tax is a transaction-based tax. The easiest way not to pay it is not to transact. In a mutual fund, I give that up. I don't decide when to sell the security. The portfolio manager does an open-end fund, right? So, Fidelity bought 10% of Google at the IPO price of 85. They still own 10% of Google at the IPO price. If I had bought 1,000 shares of Google at 85, that was the IPO price, and now it's $3,000 a share, I have an unrealized gain of $3 million. Well, $3 million less the 85. And that's not taxable. Unrealized means, my cost base, that's what I paid for the Google 85. It's now at $3,000 a share. And the easy way to avoid that capital gains tax is not to sell the Google. If I do sell the Google, since I've been at risk for more than 12 months, I would owe a long-term capital gain tax on the difference between my cost base 85 and now realize, because I just actually sold the 1,000 shares at 3,000. Now, and as I said, in a mutual fund, Fidelity will decide when to do that. When they do, there's going to be a huge capital gains distribution. And whether, I tell Fidelity to reinvest that in the fund because I don't need it or not, I'm still going to owe taxes on that. Now, ETFs are a little more tax efficient because we don't assume there's a manager there that's going to pull the trigger on, selling these. So these are more of a trading vehicle, and this trading can impact the cost structure again. So that was my little timer going off. I'm trying to chunk some of these things into 15-minute lectures, 20-minute lectures, if there's a natural break in the material. So, I have been in the past just, firing up the, the lecture and going. And, I've been trying to bring lectures in at about an hour and a half, somewhere in there, because, that's what I think a study block is. If somebody's going to watch a video, I think, and, you can always, hit the pause button if it's a little too much for you. But like I said, I'm trying to bring these in, and that helps me chunk it up. So anyways, the exchange traded funds, we'll go a little longer here, and then we'll call this installment done. Pooled investments, and we'll call it done. Anyway, so you got to be able to contrast that ETF with that. I'm not there yet. I think I probably will get there, but if I do, the other thing I would just warn you about, maybe I'll put it over here somewhere. Let's see, where's a good place to put it? Make sure that you can contrast an ETF versus an ETN, an exchange traded note. The exchange traded note does not actually own the underlying securities. It's a debt instrument. That's the test question. And you have credit risk because, the sponsor may not pay you. It's a lot easier for a financial institution to set up an exchange traded note than exchange traded fund because, they don't have to own the underlying securities. Anyways, I'll just put that there. I'm sure it's going to come up somewhere in the explication. I have practice questions on it. Now, you would buy a REIT for the same reasons that you would buy a mutual fund. The main reason you buy a mutual fund is for professional management, ease of ownership, right? And diversification. And that would be the same thing for REIT, except when I'm buying a REIT or putting a REIT in your portfolio as an investment advisor representative, it's a portfolio, not of securities. Let me get my red out again. But a portfolio, there we go, portfolio of real estate investments. And there's two versions of this. The one that primarily you're going to see on the test is the version of a REIT that does trade in the secondary market. So it's a portfolio of real estate investments. And how do we make money in real estate? We make money in real estate through rent that we get on the properties we own within the REIT, capital gains when we sell properties in the REIT. And we can also own mortgages and collect interest and principal. And so these would be what REIT would do. And then the idea here is this is a way to get in the portfolio some exposure to real estate in a more liquid form than a partnership, for example. So exposure to real estate in a more liquid form. And then remember, the idea here as an investment advisor representative is that the real estate would have hopefully some different correlation than my financial assets. So that would be the hope that what I'm accomplishing by putting a REIT into your portfolio. Characteristics of pooled investments. Characteristics of pooled investments. So that's the category. Another 3 questions on the share classes that we have. And basically the share classes we have are the A shares. So we'll go to derivatives because options are a good place to stop. So that's what we'll go for this explication. So let me get my thing there. Now the A share is the traditional share class that most of us, well, I shouldn't say most of us. One of the challenges on 65, I kind of call it a baby 7. There's a lot of investments there. And while some of you may have a 6 and a 7, it's not a prerequisite. There are some of you that are taking a 65, and this is the first and only exam you'll be taking. And if that's the case, you're going to be, associated with a fee-based investment advisor. And, one of our go-to kind of products is a mutual fund. I joke when I teach Series 7 and Series 6, and more the Series 7, I say, listen, with your Series 7, even though you have full registration, if you went to your manager and said, I know I have full registration, can I just sell mutual funds? He'd say, thank you very much. More people get where they're going without crashing and burning in a mutual fund than any other investment vehicle. In fact, their entire, investment advisory practices that only use mutual funds. We're talking about pooled investments, and the, most popular pooled investment is that of a mutual fund. And the A shares are the traditional, what I would call traditional, because I come from started as a retail broker, ended up as an institutional broker, but that's what I sold. I sold the A shares, and the A shares typically have a front end load, and they're going to have very testable, typically going to have breakpoints. Now, make sure you read carefully because breakpoints are good. Now, that's a quantity discount. And, breakpoint sales are bad. Now, these are not lectures, these are explications. So I highly recommend you at least watch that mutual fund lecture before you go take the test. But, the test, they want to make sure you understand unethical business practices. And one unethical business practice is to avoid the quantity discount to maximize your commission. So breakpoint is a quantity discount. Let's put that in there. I always use the joke like Costco, right? Costco has quantity discounts. I go, man, I don't need 2 tons of salsa, but it's so cheap, right? Now, remember the way I stay out of trouble here. If you're just a fee-based 65, this is still testable. But remember, you 6s, you 7s, remember this is the one. And if you're not a 6 or 7, just a 65, you still got to make sure you understand the easiest way to stay out of trouble is to tell somebody how they get the best deal. So I tell them about 11/10 and say, listen, if you'll agree to come up with X number of dollars within the next 13 months, the mutual fund will waive that break point and let you in at a lower sales charge. And, if you say, gee, Dean, I wish I would have done it. I didn't do it at the time with you. I know you explained it to me, but I came into some money. Good news. It can be backdated 90 days. Pretty typical. And we allow breakpoints for quantity discounts for a combination purchases. Some, mutual fund families are sponsors or distributors, but we don't allow investment clubs to pool their purchases for purposes of meeting the breakpoint. Right. So those are the A shares. Those are the traditional ones. A lot of mutual funds are actually going away from these other share classes because it's just confusing. Reps are confused, customers are confused. But in a B share, they have a contingent deferred sales charge. Contingent means, we may not charge it to you. But what, the regulators, NASA is most concerned about is misrepresenting a contingent deferred sales load as, back in loan. Usually as you stay in these long enough, they reduce it over time, but it's still a load. So, you better not misuse of no load terminology. What I charge you coming in or going out, it needs to be described as such. So those have a contingent sales charge, and then the C charge have a level load, but they have an annual fee, and that annual fee may or may not be a good idea. What I mean by that is, that annual promotional expense, well, typically we call that a 12B1 fee, is an ongoing expense. And so maybe if the A shares were 4% and the promotional expense, the annual fee is 0.75%, maybe at some point you would have been better with the A share. And needless to say, you should recommend the share class that's in the client's best interest, right? Whatever share classes there are. Remember, the 65-year investment advisor represent, but your firm has a fiduciary relationship with the client. So it's not that you should do it because it's the right thing to do. I mean, that standard is higher ethically as a fiduciary. Broker dealers aren't fiduciaries to customers. Investment advisors are. So characterize in the client's best interest. Let's put that in there. And, you can still refer to yourself as a no load fund as long as you don't charge and hold the fund out as no load, as long as that 12B1 fee, that promotional expense, is not more than 25 basis points, 25 bips. That's 1/4 of 1%. And then the max you should charge or could charge would be 0.75%. There's exceptions for that. For example, when you get in early in the B share, but for our purposes, that's fine. One more share class. Another share class we have is the I shares, and I shares are typically would be the best recommendation for like a retirement fund or pension plan. Those would be the cheapest share class. And if you meet the requirement for the I shares, that's probably going to be the ones I should recommend. Now, we talked about liquidity in mutual funds. We said that's a good thing. We said that in an open-end mutual fund, you have the liquidity at the next calculation of the NAV. And so that's a nifty thing to be able to do. So we said that one of the disadvantages of a mutual fund is you lose tax control of your investments. What we mean by that is you don't decide when to buy or sell. The mutual fund decides when to buy or sell. And when they, realize gains, that will be passed through to you. They pass through at least 90% of, net investment income, but they're also going to pass through the capital gains distributions as well. And so that's one disadvantage of a mutual fund, is that you lose tax control of the investment. If you have your own portfolio of securities for the client, you would decide. Some investment advisors who don't like mutual funds, this is one of their, ways they go out and say, listen, you don't want a mutual fund because that mutual fund isn't thinking about your personal tax return, and their investment objective of the fund may be close to yours, but it's not spot on. You could hire us and we'll create a portfolio of individual securities for you. And you have enough money that we can diversify, right? Because that's the other major reason to buy a mutual fund. That doesn't mean it's not a wonderful product. You just lose the, tax control of the investment. So the tax consequences are realized by the fund and not you as the customer. So that's one of the disadvantages of a mutual fund. I always joke there is a problem with having monkeys harvest bananas. And the problem with having monkeys harvest bananas is that they eat the product. And so, you got to pay for the investment advisor, the board of directors, the custodian. Be careful on the test. The fund, these are, costs to the fund of which you are one of the owners, right? It's a pooled investment. But the load is not paid, whether it's 8.5% or 4%, whatever, is not paid by the fund. That's paid by the customer. So be careful about, being tricked about what's being paid by the fund and what's being paid by the customer. But anyways, of those fees, the largest single expense to the fund, and rightfully so, is the investment advisor, right? He's going to eat the product. I said the problem with having monkeys harvest bananas, they eat the product. The product here is money, and the monkey is the investment advisor. So that is the single largest expense to the fund. And the more expertise I'm going to charge, more expertise I have, the more I'm going to charge you. So the investment is the largest single expense to the fund. So I'm just trying to make that distinction between there are some costs that are paid by other things. So there's ongoing fees. There's trading costs. You might want to see what the turnover in the portfolio is. A fund that has a higher, is churning over the portfolio, buying and selling securities, is going to have higher trading costs. And again, something you need to be, do that. We talked about this pricing. We said this pricing comes up as a test question about the distinction, making sure you can distinguish between NAV, and the NAV would be for open-end funds, whether they be loaded or no load. Open end is no load. So, if it was, for example, no load fund, maybe it looks like this. Because the public offering price is the NAV plus the sales charge. And if it was, a loaded fund, maybe it looks like this. That is a, max, sales charge of 8.5%. And so we said the only one that would be trading at a discount to the NAV, the only fund that could be trading that can be priced. I'll pay price because again, remember the idea I'm trying to distinguish here is that open-end funds don't trade. You're doing business directly with the fund. So that's my second 15-minute segment, which means we're at 30 minutes basically. Only fund that can be priced, I'll put it that way, at a discount is a closed-end fund in the secondary market. And that what we're saying here is they can actually ask you to pick this out of the lineup as being the closed-end fund. I told you just high probability. We should never use the word guarantee or approved in the securities industry. And, I'll try and follow that on the YouTube channel, not use the word guaranteed test question. I'll put it this way, very, very high probability that you're going to be asked about this or be asked to distinguish between those two types of funds. So make sure, again, this is just a explication. It's an intellectual inventory. So, don't think you're going to go through the explication and pass the test. This is just for you to kind of check off the things you need to know about these. So in this pooled investment, when they were discussing mutual funds, we said the major benefits of a mutual fund is professional management, diversification, and ease of ownership. It's just easier to own a mutual fund than it is. This is the easiest way for most people to avail themselves of professional management. I joke, if I have a friend, I say, listen, they come into some money. Dean, what should I do with my money? I say, do you have the time, temperament, and expertise to be managing money? And they say, no. I said, well, then you ought to hire a professional. Now, remember, very testable, since we're going to get this diversification, in a mutual fund, we're going to reduce or avoid selection risk, also known as non-systematic risk. So it's very testable as an investment advisor representative to know how to avoid selection risk. Bernard Baruch said money is like manure and you got to spread it around. If you just pile up in one place, it just stinks, right? So we're going to avoid this by, diversifying. The 10 equally suitable ideas. I picked one of the 10. The other 9 did fine. The one I picked didn't do so well. So, what could I do? I should have bought, more than one investment. Now, the other test question here is that even though we're diversified in the mutual fund, systematic risk, very testable, still prevails, right? So, there's a tendency of securities prices to move together. And, crash, if the market crashes 30%, the NAV is as well. So, high probability question, what's the easiest way for most folks to avoid selection risk? Two potential test questions. Diversify. What's the easiest way for most people to diversify in the context of a mutual fund? And then this idea of systematic risk still is still there despite our diversification efforts. All right, so that leaves us where, let me tell you where we're at in the explication. I'm certainly not going to try and get derivatives done and the rest of this done. I just want to see where we're at. So we're working our way through this thing. And yeah, so let's say in the next installment, I will get the two client investment recommendations and strategies. So that gives us another installment there. And then I'll start working our way through that. Now, as much as this is a requested lecture, that Dean, where you've been on the explication of the 65, and we have a couple of 65 people, I'm not agreeing to try and match my publishing schedule on the explication of the 65 to 65's test dates. There's just too many people taking tests and there's too much stuff on the channel for that. But I will make a commitment that I will publish the rest of this sometime this week. So that'll be the game plan. And so we covered today what would be on your exam, 3 and 3, I think. Let's see, potential 6 questions here. So there is, just reviewing here, 3 questions there. 3 questions there. So a total of 6 performance opportunities, 6 test questions in the category in this explication, this little over 30-minute explication. And then remember to like, share, comment, subscribe so you don't miss future installments. There'll be another installment coming rather quickly on this. I will talk to you later. Bye-bye.